I know you don't target the currency, Governor, but the weaker pound, the higher the inflation. So at what point does it become uncomfortable for both the Bank of England and the government?
No, we don't target the exchange rate. We take it into account, obviously, in our setting of monetary policy. So it features in our forecast, it features in our deliberations, but we don't target it.
But is there a point where it becomes problematic?
No, because I think the word problematic has all sorts of implications. I don't see it like that. We look at the things that are causing it to move. There's a whole standard way you can look at it, range of angles you can come at it from. And in doing so, we're seeking to understand what particularly is causing it.
So there's nothing that would warrant an intervention? Again, because it actually hurts with your inflation problem that you're trying to target.
Well, in the precise meaning of the term intervention, I think that's a term that we haven't used that approach since the early 1990s, and we all know the history of that period. So it's not something that we discuss in terms of our toolkit.
But is it on top of your mind, or is it just something that's a reaction?
It's part of the things that we discuss. I wouldn't want to sort of give it more status than that, to be honest.
Governor, you say the markets aren't right to expect rates to peak at around 4.75%. Where will they peak?
Well, we don't know, is the answer. The point we've made today is that we thought that the market curve had really overdone it, and that when we spent a lot of hours, preparing our decisions and going through as a committee, we really found it not just very hard, but not possible to really square our own reading of the economy and what was to come in the economy and the inflation outlook with the pricing of the interest rate pricing of the markets.
But so why give such a clear guidance? Who's it hurting? Is it for mortgage holders? Is it for people that have houses?
Well, it's certainly for mortgage holders, because of course the UK mortgage market has shifted much more to being a fixed rate market. Not the same sort of fixed rate structure as the US, but it's still much more of a fixed rate market now. So it's far more priced off the swap curve. Right. What has happened to the rate curve over the last 2 months, I think has fed through directly into mortgage pricing. So a lower curve will pass through, and of course all borrowers in that sense benefit from it.
Governor, do you think you'll hold back in raising rates where they need to be to take care of mortgage owners?
No, I'm afraid our remit is very clear. It's inflation. I mean, it's price stability. It's a 2% inflation target. We won't deviate from that. But what would obviously, things like the mortgage market and the housing market feature in our assessment of the economy and our decisions in reaching a conclusion on how to meet the inflation target.
Is 75 basis point hikes the new normal? Is it the new thing? I know we have a story on Bloomberg saying how different you are to Jay Powell in your view of the economy.
Well, I think what I would say about the US and the UK are facing very different situations and very different shocks. I mean, we're facing a huge real income shock, negative real income shock in terms of energy, particularly gas, which the US isn't facing. It's got a very different inflation context in that sense. So I don't think people would be surprised when they see that we and the Fed are looking at things through slightly different lenses and we come to different conclusions. I resist people saying, well, you should do the same as this other central bank.
Right. But do you think you'll be more aggressive in tightening quicker?
No, you really should not. The fact that we've done 75 today, nobody should read into it that's the new norm. That's not appropriate.
Governor, at some point, you'll step away from this tightening spree. What indicators do you look at to see when you can cool off a bit?
Well, obviously, we always look at what the profile of inflation is going forwards. I think then, as I said earlier on today, that we look very carefully at the labour market because we have a very tight labour market in this country. I mean, it's interesting that there's a lot of evidence that the economy is slowing. There's some evidence now that labour demand is beginning to slow, but we still have a very tight labour market. We've got a smaller labour force today than we had immediately before COVID.
But are there specific surveys or indicators that carry more weight than others that you look at?
No, I mean I think we've always in the MPC rightly sort of avoided that sort of debate because it means that individual pieces of data get in a sense too much significance, and frankly also I would say it changes over time. I mean the things we look at in the economy more particularly than others, depend upon the situation. So the labour market at the moment has a very close focus because it is so tight.
Governor, we had a column by Mr. Corcella-Cotto, which I'm sure you've read, saying that it was the Bank of England's lack of pension fund oversight that ousted Liz Truss. What do you say?
Well, I did read the column, and I think he made 2 points. The first one was pension fund oversight. Well, actually, the Bank of England isn't a pension fund regulator, but we did organise a stress test of some parts of the system back in 2018-19. We assumed an interest rate stress, as you have to. It was a bigger stress than history of the last, I think, quarter century. What we experienced in September was substantially bigger than that. Now, of course, we have to think about that poses a question to any central bank. Well, how do you react to that? I mean, what's the right place to set the stress? But I would say this was off the scale of history. The second thing, I'm afraid, where I really fundamentally disagree with the conclusion of that article was the suggestion that we stopped our intervention and should have continued it for financial stability purposes. And that's, I'm afraid, wrong, because we stopped our intervention at a point when we concluded, and I think the evidence supports it, that the precise financial stability problem we were seeking to deal with, we felt had been dealt with. And if we had gone on longer than that, we would have been creating a moral hazard problem. And that would have had a detrimental effect on financial stability over time.